welcome to the fifth in the Step Up seminar series. We're really pleased to have Jim Van Tassel from UBS here, and Tom will introduce him in a bit. Reminder, two things. The prior sessions can be found on the Center for Financial Market and Policy website under events. And we want this to be interactive, right? And so please feel free to ask questions. Now I will hand it off to my partner in this effort, Tom Bianco, who will introduce tonight's speaker. Tom.
Thank you, Lee. It's my great pleasure to introduce Jim Van Tassel to all of you. And you should note that Jim is the first of our speakers that is not a Georgetown alumni, and he's doing this out of the kindness of his heart, and we appreciate that. I've actually known Jim for almost his entire life. We grew up in the same hometown in New Jersey, and our families have known each other, seemingly forever. And I believe I actually gave you your first Wall Street job, Jim.
Yeah, Tom, you did,
yes. And so
definitely the best mentoring that I ever received, and training, I would add.
Well,
so
thank you.
I'm sure that training is coming through here at Georgetown.
I just want to let everybody know that Jim really is a unique talent, having seen many people on Wall Street. He's performed many different functions on the sell side. He's been in sales, he's done marketing, and he's also done research that is unusual. I'm not sure how many of you have read Moneyball, or familiar with the book or the movie, but Jim has done just that at UBS. He has one of the smallest budgets on Wall Street for research, and he's gotten really outsized performance. The research department's been in the top 3 consistently for many years. So with that, Jim, please tell us how you did all that.
Well, thank you, Tom. That's a very, very gracious welcome, and thank you, Lee, for having me. I'm looking forward to the next hour and 15 minutes, having a really good dialogue with everyone. I don't want to just be presenting to everyone the entire time. That would get extremely boring for everyone. So please ask questions and stop me whenever you'd like. I'm going to share with you a presentation that is a presentation I do with our clients, and something that I've just recently updated. When I go out to see hedge funds or long onlys or pension funds, oftentimes they're asking, what is the strategy for UBS? What is my strategy for the department? And these are the 3 pillars that I base it on. Top talent. There is no substitute for smart, fundamental analysts working on your platform, period. In many respects, you are putting together what is like a professional team in sports. You need great people on your team if you're going to be successful. So when I came to UBS in the Americas from UBS in Europe, one of the first things I wanted to do was make sure that I was investing in top talent. The second thing is, well, if other firms have good talent as well, how do you differentiate? And we think a lot about the way we distribute our content and how we can make it easier for the buy side. I think about disintermediating the buy side's workflow when I have meetings with the buy side. I want to make their job easier by doing things that they would do in advance of them doing them. If you think that we are effectively a consulting arm for UBS, where we're providing information, data, advice, guidance to our clients, you want to anticipate what they're going to need and try to do it before they do it. If you can do that, then you're going to embed yourself into their investment process. So we talk about the thesis map that articulates our view in 1 page. I'll get more into the thesis map and how it came back shortly. We adopt a way of signaling to the market through campaign marketing that we have high conviction around one idea. And we are very visible on that idea by writing on it consistently, by doing events like expert calls or corporate access or anything we can think of that provides a better view on the entire mosaic that the buy side's going to use to analyze it. And then the last thing, which is relatively new, is the ARC. There are a number of third-party expert firms out there, GLG being one, GuidePoint, a number. I've always felt that the analysts are actually some of the best connected people, but they're so busy that we can't do that in a systematic way, or they can't do it in a systematic way without help. So I built a team internal at UBS. No one else has this on the sell side. And now we work with the analysts to find scope. Where do you need more experts within your network? We focus on private companies, and we're now up to close to 800 entrepreneurs surrounding the analysts. We have conversations with them. We share information with them. They share information with us. Eventually, it makes everybody smarter about what's going on in the business. And then the last part of the very important mix is data. There isn't a single firm on the buy side that isn't constantly speaking to me about how they can better incorporate data and analytics into their investment process. UBS, under the guidance of Juan Luis Perez, who came from Morgan Stanley, built the largest sell-side data team called Evidence Lab in the world. And we're producing data sets across, as you can see, 55 different products. We cover companies all over the world, and we have different verticals of data scientists and experts that my analysts work with to help try to drive systematic information advantage. And that is a term that we use quite a bit at UBS. I'm going to come back to that in a little bit. So if you think about what our offering is, our offering really consists of coverage on public equities. So we've done a lot of launches. There's 830 North American stocks under coverage. We also have offices in Mexico and Brazil. We cover another 180 stocks there. And the goal is really to drive that up to 1,000. Why do you want more coverage? Some people just say, well, just do a better job with the coverage you have. Well, you want more coverage because, of course, it leads to more opportunities for interaction with our clients. And they are picking through more than just 830 stocks to determine what they want to buy and sell. Because market caps have increased as the market's gone up, there's a lot of mid-cap stocks that trade with significant liquidity. So we want to get up to 1,000, which is going to drive, I think, a better outcome for our clients. And then in addition, keep driving the coordination between Evidence Lab and my fundamental analysts. We want more and more of that alternative data product in there. And the more we get, the more our clients want. And then finally, I talked about building the ARC. Hopefully, we're going to see a lot more getting together of that network as we go into 2022. COVID starts to relax a little bit, and we can do some differentiated networking with those. All right, so I focused a little bit on the thesis map. I talked about campaign marketing. We're going to discuss quality and what that means when we talk about reviewing our content, especially changes to our views. We have quite a bit of structure on that. And then I'll get into the ARC and Evidence Lab.
If you had to put together a one-pager for clients, what's the most important element?
We wanted to talk to our clients about what they wanted. And what our clients said, and this was 600 blind roundtable interviews that we conducted in Hong Kong, New York, and London to really structure what does the buy side want on one page. We know what the buy side generally would like. They want us to help them make money. But what is the information that they think they need to be better investors? So after conducting all of these interviews around the world, this is what they identified. This is really what we aren't picking this. This is the buy side indicating through these interviews that this is what they wanted. First, what are the pivotal questions? Right? There's lots of questions you can have. Is the management team good? That's a reasonable question. Probably has no impact on what the stock's going to do in the next 3 months, potentially. You can say, do I think that they're going to be impacted by commodity costs? Well, depending on what kind of company it is, that may or may not be pivotal. So what we're always looking for is, what do we think are the questions that are actually going to move the share price? And sometimes those questions are different than the fundamental questions people often tend to think about, right? They also must be quantitative. I don't want a question that doesn't lead to a quantitative answer. So if we're looking for something like, what do I think margins are going to be for this product? And I think that product is the most important product that they have. It's a new launch for a company. They've spent a tremendous amount of money building this product, talking about this product. The market is anticipating it to be successful. What do they have to do then to meet what the market is expecting? So there's a lot of work that goes into trying to understand what's pivotal. We feel like if the analysts are having a significant amount of conversations with the buy side, they're going to be able to drill down into what's pivotal. And that's very important. So think about that. I'm changing the idea from I'm the analyst and I'm deciding what's pivotal to I'm canvassing all of the investors. And in those conversations, I'm acting as a sounding board where investors are saying, I think this, I think that, I think this. Guess what? If the top 20 investors of a stock all think one thing is pivotal, it is. If that moves a different direction than the way they think it is, that's going to move the stock. So it's both a combination of the analyst having a good fundamental understanding of what drives the business and also having a lot of conversations with the buy side. What do you need to do next? Well, obviously evidence. You can't have a conversation with a client and bring nothing to the table. You must have done work in the background. We're hoping that work combines with data, and that data can be either long-standing or episodic. When I say long-standing, it could be something like we're scraping pricing over and over again on luxury good, maybe handbags. We're the only ones that do it. We clean the data. We look out for changes like Chinese New Year or Christmas so that we get an even distribution of the data, clean it, and then we have an advantage because no one else has it. That can give you an advantage. Or it can be something episodic, like when we took ball bearings to try to compare Chinese companies to Swiss companies and put it into a centrifuge and ran it for a year to determine if there was any metallurgical differences between the ball bearings, and there wasn't. That was a big deal. Chinese ball bearings are significantly less expensive than some of the Swiss companies. So that would be an idea of evidence. And then what's priced in? You have to know that. No matter what happens, if you don't know what the market currently thinks about what's priced into the stock, you can get completely run over and still be right. So if you think they're going to meet numbers, but everyone else thinks they're going to beat numbers by 15%, and they meet numbers, and you're thinking, well, I was right on the money. I kept my buy on the stock and they hit their numbers. Good luck. Stock's going to go against you. Out of consensus, well, I think this goes back to the key thing that I learned from some of the hedge fund managers that I used to cover, which was I need ideas that other people don't have, right? So I need to make sure that I'm not in the mainstream, because if the idea that the company is going to make 15, it was like Microsoft. Everybody thought Microsoft was a great company, and it was for many, many years. Stock didn't do anything because everyone else thought it was a good company too, so you were never at a consensus. And then the final thing that we do is take a look at upside downside. That is basically, what do I think could be a really good outcome for that product per se? It doesn't get 5% market share, it gets 10% market share. What does that extra market share mean to margins? What does that mean to earnings? Downside could be, I think that product doesn't get 5%. I think it actually fails on release. And then what does that do to my cash flow or earnings or whatever I'm looking at.
You've now gone through each of these and what they represent with
Mhm.
examples, which is terrific. But did the clients give you a hierarchy of what they want to see first, second, third, fourth, or did they think these were equally important? And does it depend on the type of client? Where hedge funds leaned you one way and long onlys leaned you another way? And
Yeah, it's a good question, Tom, and there is some variation, right? Hedge funds are really focused on what's priced in
Yeah.
because they're really thinking about the volatility of the dollar that they have, right? Long onlys are much more focused on sometimes picking good companies and holding those companies for a long time to get a better tax outcome, right? They don't want to churn their portfolio. They don't want to do that, long onlys particularly. Hedge funds are more interested in, if I had 7 great ideas over the course of a year, that's 7 times I could use that dollar that I have, which I've leveraged at least 3, 4, 5, 6 times. So then I could get a really good return. So what you find a lot on the hedge fund side is, as you go into the quarterly results, we're doing a preview call with literally 50 to 100 hedge fund managers on that call and very few long onlys. Long onlys are only really calling us on the earnings if something very unexpected happened and they want to drill into that.
So the long onlys, for example, would really be the pivotal questions, and they'd be looking at where the evidence is and be following that more closely in terms of a longer period of time.
That's right.
Where the hedge funds are very interested in questions 3 and 4, probably in 5.
And 5, because they want to determine what their risk, profile is on the trade. Also, hedge funds generally, the bigger multi-platforms keep very tight loss limits now on their funds. So if you're down a few percent, you can get stopped out on your position, right? And I mean, a few percent. It doesn't have to be much more than that because you are using leveraged money. So 3% is quickly 9 or 10% loss on that investment, and that's when your risk manager at one of the big funds is going to come along and stop you out. I think a lot about what hedge funds want with some of the hedge fund managers that I covered, where if I spoke to them, they'd say, what have you found out? Is it material? Meaning, don't call me if it's not going to really move the stock. And how do I make money? So what's the catalyst? So one of the things that we don't have on here that we probably should is, what's the catalyst? How am I going to get paid? When am I going to get paid? So we've thought a lot about adding something around the catalyst and the timing of the catalyst, or what are the milestones that you're looking for that assess that you're actually getting closer to when you make your money. So that's actually something we're constantly looking to revise the research and make sure that we're staying where we need to. And what I've talked about recently is, do we need to put in something explicit about catalysts?
And Jim, what percent of the clients are long only or hedge funds? How would you categorize them or put them in buckets, and where do they fall in those?
Well, a lot of the new startups, there's not a lot of new long only startups anymore. Mostly if someone thinks that they're a very good investor, they tend to gravitate towards the hedge fund business. So in terms of the volume of new startups and new clients, it's predominantly hedge funds. And then the long onlys, they're in sort of a battle of market share where they're kind of duking it out all the time between, the big ones like Fidelity and Capital and Wellington. And they just seem to kind of have more and more success because they have huge teams, very well known, history of performance. So if you're looking for a long only product, people tend to go with that. Whereas people looking for, I want to make a bet on a really successful, smart new hedge fund manager, will go down to some of those new launches and try to add exposure. Remember, there is a level of money that a hedge fund manager has or a long only manager has, where they go from being nimble to finding it very difficult to get that much money to work. So there's many investors, pension funds, universities, and others that don't want to be in big firms because they feel like, one, SMID cap has more alpha, and it's true. I mean, quantitatively, you can prove it. So they want to be able to, latch on to managers that are doing 500 million or $1 billion under management versus someone who has 10, 15, 20, 30 billion, because it just gets harder to make returns on that much money. There's fewer stocks that you can invest in where you can actually see if that stock goes up, it's going to move the needle for your portfolio. Otherwise, you wind up, everybody's in Google, everyone's in Microsoft, everyone is in FANG, because those stocks are the only ones that have liquidity to allow them to really move around. I'll go to the next slide.
One more thing, just in simple numbers, of your top 200 clients, how many are hedge funds and how many are long only?
It's probably 60-40 hedge fund.
Okay.
And that's moving more towards hedge funds every year. That started probably the other way 4 years ago. So one thing I will mention that I do focus on is the quality of the product at UBS. This is, in some respects, like a media company. I'll publish 15,000 documents this year, and we have certain rules in place for what is allowed to be printed and published. And to make sure that happen, I have actually 3 now product research management approvers. I also have myself, my deputy research. So there's really 5 of us that are consistently going through research. What are we looking for? We're looking to make sure those pivotal questions are as I described them. Are they pivotal and are they quantitative? How are you using the upside downside? Are you basically saying that it's going to be symmetric? Because it never will be. It's always going to be asymmetric. So are you thinking about that? Do you have evidence in your conclusions? What's the evidence? We go through what's priced in, and then we push the analysts on their recommendations and their ratings. Why don't you have this rating? Stock has been going down, stock has been going up, stock has been flat. Our prior look at the news flow would indicate that you should be more negative. Is it coherent in what's happening in the wider market and in the macro? Do you understand that you're getting more bullish on a company that is particularly tied to rates? Do you understand the correlation between rates and prior performance of the stock, this stock, and let's say, macro events? And then what is your methodology for your price target? And this is really where you spend the most time, because not only for regulatory reasons, right, post Spitzer and the Spitzer settlement, rules were put in place to make sure that analysts' targets and ratings were challenged by the IRC process, but there's wide variation in how much challenge you get based on the firm. I think we do quite a good job of it.
2 things. First is how often do you have to push these back to the analyst or back to the team saying, we don't think this passes that hurdle, right? And second, is it just the analysts are trying to guess what the IRC would view the firm as, or right? So what is the sort of the independence level here, right? One of the things that we want to try and get our students to understand is this governance structure. And so any more feedback you could provide on sort of how it works would be really useful.
So there's certain triggers that require the analyst to make, to write a note, right? It could be a 10% change in target price. You could be out of band. So we have banding, right? Banding for these stocks. If you go out of band in terms of you have a sell, but now it's dropped below your target price on your sell, you need to upgrade to a neutral, because you're now out of band on your sell, and vice versa on your buy. If your buy target is 20 and it's now at 30, we would expect you to adjust that down to a neutral or a sell. The
So
only way
this goes to analysts need to constantly be reevaluating their opinions on the basis of new information, what's happening in the market.
That's correct.
Okay.
You cannot sit there. What we do is we have what are significant data and risk packs that analyze every single stock, where it is relative to your rating, where it is relative to when the last time you made a change on it, when was the last time you changed your pivotal questions, when was the last time you adjusted your upside downside, where is it trading relative to your target price, what would your recommendation indicate? And I get that data every single day. It goes to the analyst dashboard. They're seeing it all the time. And then if they're out of band, we let them know they're out of band, remind them, they should know. Obviously, they're having conversations with clients who are telling them you're out of band. And then if they don't do something in a timely fashion, we suspend coverage. So I will not sit with a stock that is out of band for very long, because what that indicates to me is that the analyst isn't on top of the stock and is not on top of the story. And therefore, we need to suspend coverage until I'm satisfied that they are aware of everything that's been happening with the stock and ready to write and have conversations with our clients on that investment.
And Jim, does the IRC have a recommended list, or are there, I know there's some firms on the street that do this sort of, it's not just the buys, holds, and sells that their analysts come up with, but they come out with a recommend. Do you have any of that kind of structure in place? And what do you think of that?
So do you mean, do we have like our top 20 list?
Yeah,
Yeah, so we do baskets throughout the course of the year based on different ideas that we may have. I asked for a basket recently, which was a basket of growth stocks that had underperformed. We made clear to say that, that basket was not in line with our strategist view. Our strategist view were growth stocks were going to continue to decline. But clients were asking for it. And basically all that is then is just looking at the data to say, well, target price is here, stock has dropped to here. Has there been any change in fundamentals, earnings, estimates? No, not that we can see. So that means usually you're looking at a market drop. So valuation is now more attractive. And we might publish something like that.
so that's like a wish list.
Yeah, that could be a wish list that's,
or
top 22 for 22.
right.
We do consistent growers, compounders. We do stocks the other way on the sell side, which is these stocks are most overvalued relative to our fundamental view based on our earnings estimates. That's really all quantitatively driven. We're not really overlaying fundamentals on that.
Jim, some of the other people who've come through here, and those of you, these are all standalone, you didn't have to be here, but talked a lot about the importance of communication. And what I'm looking at here is, this seems to be a massive amount of information you'd have to put in essentially a one pager. So brevity somehow has to be key here.
Yeah.
How do you do that? How do you get your analysts trained to sort of cut all of the excess out?
Through the IRC process. Right. So through the IRC process, they write, they finish the note, they give it to us, we edit the note, which they don't always like, to be honest. They don't always, a lot of analysts don't like, the IRC team editing their note. But what we're trying to say is literally, what's your point? Like, I'm not looking for a dissertation. And there are some times where we write notes that are, we'd call it Q series, where we're trying to tackle a big topic. Maybe that big topic could be, the impact of climate change on certain industries. And that's going to be a very long and 100-page, 150-page report. But for these notes, for the vast majority of the notes, we're trying to get you to talk about what I just said, which is, you have a view. Do you have evidence? Is it material? And when do I get paid? And if you're pretty much sticking to that, everything else is going to work out, right? Because that's what if you're speaking to me, you don't get into all the hyperbole that you do on the page. Everyone likes to write way too much on the note. And if you have a conversation with them and you say, tell me what your thesis is, it's usually much more abbreviated than it is on the note. So I don't even really have to necessarily edit the analysts. What I usually do is I just say, I have your note, tell me what your thesis is. They tell me what the thesis is. I say, go back and look at your note. Why don't you just say that? And usually they say, okay, that makes sense. So they go in and make adjustments.
So Jim, do you have a UBS branded one pager of these are the 5 topics and fill in the blanks, or how do you structure that?
The 5 topics for who?
I'm just making up 5 topics. I'm just saying, is in your one pager, do you have something that, within the research department, UBS sort of branded one pager that everybody answers the same questions or does the same thing?
No, we used to have something that was done by the prior director of research, and we don't anymore. We don't have that. What we do use with the thesis map pages are used quite extensively by our wealth management in the Americas. So if you think about the wealth management, the retail channel, they find that product very helpful because retail brokers are not going to read the entire report. They want to basically understand what's important on one page, and then they utilize that for their clients. Additionally, we find that if we're putting a summary together of our top picks, we'll just use that one page for each analyst, and that will be what is in the note.
Great.
So why don't I go on to the next page? This is just a kind of description about the way we approach trying to get our content to our clients. Clients are inundated with notes, phone calls, emails, invitations. It's very difficult for them to figure out who to pay attention to. So what we do is we say, I want you to write a report. I want you to do something maybe that's in an interactive model so that the clients can play around with scenario analysis, which we think is important. Do a video publication. Let's do a conference call. Let's give feedback on what you heard was important from clients. That's always interesting. Maybe the top 5 questions on the report. Do another follow-up publication. Maybe we do a deeper dive on one of our pivotal questions. Another live event. Maybe have someone come and talk about what makes them agree with you. Work with the company or something. Maybe we get an expert, a key industry consultant. What you can see here is that can take you out many weeks, but oftentimes it doesn't require you to go back in and do a whole bunch of new analysis, right? Remember, we're trying to drive interactions between the buy side and ourselves, and we need those interactions to get votes and get paid. So if I run just an academic research department where everyone's just writing notes all the time and no one has any time to speak to any clients, that's not good for us. So I need to make sure that they're out and speaking and engaging with clients so they can find out again, what are the key debates? Because if they never speak to them, they won't know. And also forming relationships with the buy side so they can have conversations and build trust. You don't really take recommendations from someone you don't know or don't trust. So hopefully all of these things that happen lead to more, interactions and more collaboration between the buy side and the sell side. So we do this. This has worked for us in terms of driving awareness of our key ideas and also driving awareness of certain analysts. This is a further description of how we systematize the approach I just discussed. We have points for what the analysts do. We keep track of it, and that helps us make sure that the department is actually doing what we want them to do.
So Jim, this sounds a little bit like, sort of, I guess, in the old days, or you'd have the view of analysts just kind of being in a cubicle somewhere, doing their own thing and not having to deal with other people, right? but this seems to suggest that not only do they need to worry about their written communication, but also their people skills and their oral communication is going to be critical to their
Yes.
success. Does that seem fair?
Yeah, so I'll give you an example. MiFID is the market-driven directive in Europe, which started in really around, I think it really got into place in about 2017. And at that time, what the UK regulator, who was quickly followed by the European regulator as well. So in Europe, you have a MiFID regime. You only get paid basically a small, let's say it's $10,000, $25,000 for your written work. That's it. Everything else is for the time you spend with the clients and the value they put on that time. In Europe, it is a true consulting model. And many of the largest long onlys don't run a different business model. So the same business model they run in Europe is the same business model they run in the US or in Asia. So absolutely, my analysts must be thinking about how they're getting an hour with this client, an hour with that client, an hour with someone else. Because if they don't, then we're just a publishing house. Publishing houses don't get paid very much. So we absolutely need to figure out how do we get more interactive with our clients, and this is part of the reason we do that.
Thank you.
All right, we'll talk about the ARC for a second. So if you're thinking about how do you build a differentiated view, we'll talk about data in a second. The second thing that helps you build that view is you have a deeper network than another analyst, right? We're always talking to friends and family, getting advice. We're always talking to our peers. And then at work, you're talking to a lot of people, bouncing things off them, et cetera. If you can do that with more people from your industry that you cover, the better off you're going to do. So, but here's the problem. You can't do that with public companies. Public companies have what's called Reg FD, which is Regulation Fair Disclosure. That means they can only tell you what they tell everyone else. So what they put out in their report is what you're going to hear from them if they speak verbally. What they say in the conference call is what you're going to hear from them if you speak to them independently one-on-one. That is a key regulation, which means having conversations with your corporates is good, but generally if you read their transcript, you're going to know what they're going to say to you. The area where you have more opportunities for information is within private companies. They're not public, so therefore there's no material, non-public information, sensitive information that they can share about their company because they're not public, can't trade their stock. So we try to expand the number of private companies, academics, whoever we can think of to try to grow a more, I'd say, built out network around each analyst and help them better understand what's happening. I'm surprised, most of the sell side has kind of given this over to third-party providers, but right now we're trying to do it ourselves, and we're having actually a good deal of success and a good deal of interest from private companies to join. I'm going to skip on to Evidence Lab. So we talked a little bit about Evidence Lab before. As I mentioned, it is a very large team. We started in 2014. It says 6,000 differentiated UBS reports. I think it's closer to 7 now. These are some of the capabilities that we have: geospatial, digital engagement, natural language analytics, supply chain, nowcasting, price intelligence, market research, keeping track of tankers as they go around the world, vehicles traveled, distances in the United States, what's happening at ports. And then some of the basic stuff, we do a lot of surveys. And we keep those surveys on an ongoing basis so that we have the data and we can pick out inflection points in the data. Now, all of this, we released the data in our reports, and then we also sold the data, the raw data, to our clients, because sometimes they don't want the data going through the lens of the analyst. They just want to take it themselves and work with it. So we make that available to them. I think what's best is the combination between the analyst and the data provider working together to try to figure out how we're going to get systematic information advantage. I give some examples, right? So my Hardlines analyst has been doing this very long-standing survey of what's going on in Hardlines, and it's given him frequent information that helps him understand what's happening at Home Depot and Lowe's. And then this was a total ad hoc. We wanted to better understand Siemens. Siemens had a big management change. The old management constantly missed their deadlines for new projects. That weighed on the stock relative to where we thought the valuation should be. Their biggest new project that year was going to be in Egypt. Nobody knew if they were going to make it on time or not. So we took satellites and then hired engineers to say, all right, look at the foundation, look at the electrification. Are they on scale? And we just kept those pictures coming all the way up as we get closer and closer. And what it made my analysts feel very comfortable about was, yeah, they're going to hit their target, which is going to be a big change between old management, new management. That's going to lead to a revaluation on the stock. And it did. They actually hit their bogey on that. Now, we're probably not going to do that again. Like, there's no reason, once the thing gets built, there's no reason for us to go and do that again. So you need a mixture of the two things to help you understand. That was a particular question at the moment, which probably was no longer relevant. So you wouldn't want to do that again. However, there are questions about surveys and what people are buying and what their intentions are in terms of their homes and fixing their homes, et cetera, that you want to keep running over and over again. And that's an example of how the evidence lab works with the analyst.
Jim, with your evidence lab, I mean, it sure sounds like they're not necessarily finance people. So there's a couple of things here. For our students who maybe want to go to be an analyst, right? Are there skills that they need in terms of data science, or are there things that you could recommend? You might want to start looking at this, because you guys have really been pushing the edge of, or pushing the frontier, right? Of, let's call it alternative data. And so from your seat, are these things your analysts need to know, or just being able to work with the evidence lab people?
It's a very good question. So we thought about, you have analysts and their core ability is storytelling, listening and understanding what's the most pivotal questions and what's happening. And then do I want to try to teach them geospatial? Do I want to teach them how to do a correct survey that's not biased? Do I want to get them to understand how to clean data? Not really. Like, I don't really think that's a good use of their time. However, what my colleague and I, Dan Dowd, he's the global head of research. He would actually like more social scientists. He really wants to understand how we think about causality, and if there's a way to strip out certain variables to get you closer to understand what's driving a stock. He would like the analysts or the new analysts to have a more social science background and understand how to take data. So maybe understand how to use Python. So there is a growing awareness that data plays an incredible part, most likely in future investments. I think there's a healthy debate over, do you need that to be the same team? BlackRock, T. Rowe, and others are actually now moving away from having a centralized data team that tries to influence the fundamental analyst to taking data scientists and embedding them in the fundamental team. So there's lots of different things being tried by both sell side and buy side to try to figure out exactly what works best in incorporating more data into the decisions that get made.
On a very practical or pragmatic question, right? If our students want to make themselves more marketable, whether it be to somebody like UBS or even on the buy side, are there tools you would recommend here, right? We used to, in the old days was like, well, you just needed to know Excel. That was basically the only thing you needed.
Yeah.
Now that the number of tools is just growing exponentially, do you have advice for them on where maybe they should focus not that they have a ton of spare time, but
Sure.
in terms of
Nobody does, right?
no, in terms of kind of tooling up.
Yeah, I mean, obviously, there's no doubt a good understanding of statistics is important. I think understanding Python is important, and being able to do some base level coding is important. Those would be probably two good areas to start. It hasn't changed in Excel. Most of our models, if not, I mean, still, yeah, really like 100% of our models are still on Excel. So your ability to utilize Excel quickly and efficiently to drive, a quick changes to the models. Remember, you might be covering 36 companies with you and one other associate, and the lead analyst is asking someone to pick out key details of what's changed from the earnings result. And if you're fumbling around on Excel, you're not going to be much use to them. And they're trying to get a note out in real time where investors are calling to try to get feedback. And of course, you can't speak until you publish, because then you're front running your publication, which you're not allowed to do. So you have to be quick and agile and have associates that understand how to move around in the model. So really, if you can model well, you'll always be sought after, because we can teach you the other stuff. I have significant training that I do for young associates to help them understand how to code or understand how to do social science. We actually teach it. So if they don't have it, we can teach it to them. But if they don't have the basics of accounting, don't have the basics of trying to understand valuation, and can't really move around Excel, it's going to be tough.
Thanks. And for somebody who teaches valuation with in Excel, I just want to point out to all of those of you who took my course, I did not pay him to say that. That was completely independent. So thank you, Jim.
You're welcome. We're constantly going back over Excel. Like we bring in our accounting evaluation team at least 3 times a year, and we actually now do secondments for 2 of the biggest hedge funds in the country. We're the only firm that does that, where they give us their intake and they train with us for a year, just because the training programs that we have at UBS are, I think, superior to what the other sell-side firms do.
Oops, sorry. I was going to bring that up.
Yeah.
In investment banking right now, the private equity firms use the investment banking departments to take people out of their 2-year training program or something else, and to bring them into the private equity, often making them deals with them just when they start. And what's going on the research front with investment firms? Is it are you the only one doing that? Are you actually taking in a number of people and then understanding that they're going to go to the buy side?
Well, they're going to go anyway.
Is it the long onlys, or is it the long shorts, or is it any particular group? So.
It's primarily hedge funds, because they have the fastest turnover and the most new startups, and everybody watches the movie Wall Street at some point and thinks they're going to get really, really rich if they go to a hedge fund. That's not really true. But what they do is they have a lot of new funds starting all the time. And if you're starting a new fund, you really have no time, because of your requirements to run risk and make the investments. You have no time to mentor anyone. So you can't do it. So it's all out war on talent. They're constantly coming to take my research associates to hedge funds. It's less for long onlys. Long onlys, they're offering maybe a lifestyle change for some people. Some people don't want to work the hours. Long onlys are maybe more 9 to 5. So they choose to go there. But most of the people we're losing to hedge funds and private equity, both. And so I figured, if I'm going to lose them anyway, I might as well try to mitigate that by inviting them I'll just train them for them, and they can take them after I'm done. And then that way I can keep an idea, or I can actually keep track of my attrition. Like, I know these 5 people are going to leave because they finished their secondment, as opposed to what 5 people are going to leave. I have no idea who's coming around the door to take them next. So the investment banks obviously serve a pretty important purpose, which is training the next generation of private equity players or or hedge funds or long onlys, because most of those firms don't have the capability to do training on the scale that we do.
Jim, David Cho is in the chat, has a really good question, which is just what distinguishes good modeling? How often do people use maybe VBA with their analysis, right? The training the street, people will always say, well, good modeling is you don't ever touch the mouse, right? Or what would you describe as, what is good modeling? What's distinguishing the people?
Accurate, right? We're publishing 15,000 documents. I do not want to do an erratum. An erratum is when I have to do something because someone's made a mistake. They've used the wrong, discount rate. They've fat fingered something. They've put the wrong number someplace. You just have to be very, very accurate about what you're doing. If it takes you a little bit longer than someone else, but you never make a mistake, I would take that all day. So that's what we're talking about. Remember, I'm sending these documents out to thousands of retail investors who are getting them, who are not sophisticated investors. We can't have any mistakes.
Thank you.
ESG. So for us, I think what's interesting about ESG, there's differences globally, and I think this is probably one of my last slides. There's differences globally in ESG. What is important to someone in Europe is different than what's important to someone in the United States. In the United States, as opposed to Europe, we tend to see our buy-side clients focused on the risk that ESG may pose to their holdings. So if I buy, Apple, what is the risk that there's chemicals being used in the construction of their iPhones that are being dumped into into nature or into the ocean? And does anybody know about that? Could that be a problem for me? There's lots of potential risks around ESG that could be reputational risks for some of these companies. In Europe, it's a little bit more, they're a little bit more saying what has a high ESG score, and then going as far as buying that because it has a high ESG score. That's run into a lot of problems because there's greenwashing in Europe. They're paying to get a high score. So there's all sorts of investigations. Because of all those investigations, because people are paying for greenwashing, because there's so little understanding of what makes something positive for ESG, I don't think we're going to see that happen in the United States in the near term, because there's only a few firms that are doing the ratings. And I will tell you that a lot of times those ratings make no sense to me in terms of why some company has a positive rating versus another company doesn't. And it's very difficult to ascertain what's driving that. Sometimes you wonder if it's because of payments or subscriptions or services that they're getting. So I think ESG for us will continue to be about what do we think risks are to the company and making sure that our clients know about those risks. And that takes me to the end.
And Jim, on ESG, there's a lot of questions that come out of academia about that.
Mm-hmm.
What prominence do you see it right now? Like, what percent of clients are concerned about this, and how do you see that if, as you look out in the next 5 years, growing in prominence?
It will definitely grow in prominence. I think there is a very large demarcation between long only and hedge fund. Long only, who for many years had seen significant outflows of assets because of poor performance relative to passive indices, really embraced ESG as a differentiated product offering for themselves. I would note that oftentimes those funds have some of the highest commission rates on them. So it's both opportunistic and commercially savvy for some of the long onlys to do that. The hedge funds, when we talk about ESG, really aren't interested because they're trying to drive performance, right? They're trying to drive performance right now. right? They want to have a great year. They want to be compensated for a great year. So they're looking for the best pair trade that they possibly can. They're looking for the stock that's going to underperform the most relative to the other names in the group. They're looking for something really fundamental to buy or sell today. So I think we'll have to see what happens with ESG and some of the investigations in Europe into greenwashing, and see what comes of it. I do think it grows in prominence, but I think we're still at the nascent stages of really trying to figure out what deserves a good score and what deserves a bad score. Obviously, I think it's a little easier for people to say, I don't want to be involved in energy. That's clear. There's no doubt fossil fuels and burning carbon, you can make clear assumptions about what that does to the environment. It's just much trickier when you get into quote S and G, right? And that's where we haven't gotten to where we need to get to yet. So I think until we cross a couple more years of understanding, I think it'll stay with the long onlys, and I think the hedge funds will continue to pay less attention to it.
So Jim, there's a question in the chat, but before I get to Alexi's question, just on the ESG part, right? Because the G, which stands for governance, is something that for probably 2 decades we've sort of focused on, right? Governance was never a new thing. It was, should you split the CEO and the chairman role, or what does the board of directors look like?
Right.
And I think when people talk about it now, it's more on the E, the environmental side, right? Climate change.
Right.
Are you noticing?
And you still see a failure in G.
We do.
I mean, you still see internet companies coming out with massive supermajority voting shares. People don't care. They buy the IPO anyway. I mean, you've seen any number of those stocks. Snapchat is a great example of people just saying, well, I don't care about the G. I'm just going to buy the stock because I want exposure. And that's when you see the inability to really enforce better governance on the companies, and people just stop caring when they think they're going to make money.
So what I was getting at is, are we more on the environmental side, or the social side? I mean, the environment side is a little bit easier to measure as
much more on the environmental side. And that's much easier for everyone. I think everyone acknowledges that, you can think about extraction companies, if you're thinking about fossil fuels, coal companies that are digging, utilities, MLPs, E&Ps, like you can do the work on that. It's when you get into different companies and you're thinking about societal. We had lots of questions internally about Facebook, lots of questions about Google. There are societal implications for some of the things that they've done. Where do they score? And that is really difficult to put a number on. So I think the environmental, I think it's really E only right now in terms of the focus for a lot of investors.
I think I would agree with that. And by the way, on the academic side, right, the E has gotten a lot of focus. There's the climate change economics, right, and how is this affecting? Certainly, real estate is a big, right, low-lying areas, but supply chains. So I'll come to Alexis' question in a second, but Ian is on this topic. Would you characterize the American and the European approaches to ESG as risk due diligence versus impact investing? Right, which I think is an interesting way to think about that.
Yeah, I think U.S. is risk due diligence right now, for the majority, and Europe was more focused on impact investing. The only problem on the impact investing in Europe seemingly is that many of the companies outsourced the rankings of the European equities to third parties, and those European third parties didn't do a great job at it. So the impact investing portion of it, I think, is somewhat predicated on having a good understanding of really where those companies rank, and it's difficult. So they'd like it to be more impact investing. They're just having trouble figuring out outside of E what to do. And in the US, I do think it's risk due diligence. However, I do believe that some of the long onlys are going to continue to explore more ESG portfolios and put an ever increasing weighting on their own internal ESG. That's what I've seen in the past 12 months, which is if I approach someone and say, would you like us to do more rankings? The answer from the big long onlys is no, don't bother. We're going to do it ourselves. So what that means is you're going to have hundreds of different rankings because you have hundreds of different investment firms, and everyone is going to do a different ranking almost in a different way. There won't be any uniformity to it. And then you have very different holdings in portfolios based on how the different firms look at different ESG factors, which is going to be really hard for investors to think about because investors will not know what to do. They'll have to they'll have to really understand the way they think about their factorization.
I think this actually, Alexi's question will help kind of wrap this whole thing up because, you were saying, Tom had asked you what the makeup of your clients was, and it's sort of shifting. Alexi's question is, what are the main substantial differences, I guess, if any, how you communicate regarding your research to maybe single family offices or small hedge funds versus institutional investors with large teams, right? This is on the communication side. Have you seen a change? Has there been a change in the way you present depending on who the client is?
So not in the way we present our research. So that's going to come out the same for everyone, right? There's the format, the disclosures and everything else. We don't change that. So a wealth management person is going to see the same format that someone else is going to see. I think what your question is really around the communication between the analyst or the salesperson and the family office, or the salesperson and the small hedge fund, and or the analyst, speaking to them as well. And there are variations as investment professionals understand their clients. There's always differences in the way they approach those conversations. So what their risk levels are, what they have in the portfolio, what they know they've bought before. So I wouldn't say that there's, a way you treat a smaller firm differently versus a bigger firm. I think it's more you treat everyone, you're supposed to be getting a bespoke service from your salesperson or from the analyst. And what we hope is the analyst has a conversation to understand what are the way you're thinking about investing for your portfolio, so they can do a better job at giving you advice.
Well, thank you. And thank you, Ian, for the question, Alexi for the question, everybody for the question. I hope you really paid attention to not just what Jim was talking about at UBS, but this idea of, governance within the equity funds, right? The idea of an investment review, the ERC, the committee, right? As well as how important it is for to be able to communicate well, both in written and in oral form, and to do it with brevity. All right. And so hopefully this is something that you've pulled away from many of our speakers here. Tom, anything you wanted to add here?
Just on Tim, while you're saying that.
Yeah.
So everybody that we've had so far, the 5 speakers, have all been to the sell side of the equation. So they have all been people that are, their clients are the people that are actually making the investments, buying the securities, getting the performance. Tomorrow's our first flip into the buy side. So for Jim's sake, Tim Creedon is, the director of research at Neuberger Berman. I'm sure you know him. And so he is going to be telling you how they consume all of the research that Jim and the other firms are coming up with, and, how they take that and turn it into investment decisions. So it's very important sort of follow up. And that then leads to our second series of 6 sessions where we're going to have portfolio managers speaking to you. So they are all buy-side people. So just in closing with Jim, Jim, as I started off, I want to thank you. You're not a Georgetown alumni, but you wanted to share your knowledge to students and to members of the Georgetown community. We greatly appreciate your
Well, it was a
taking
pleasure.
so much time to do